Hello, this is Mark Smith. It's January 2016, and I hope your new year has gotten off to a good start. To accompany fourth quarter reports, we've prepared this brief market summary and outlook video. This video is best viewed in full screen, and you can always pause and resume the video by clicking the screen. Well, not much can be said of 2015 except there was no place to get meaningful returns. It's very unusual for there not to be at least one major asset class that performs well for the year. The bright spot is that the fourth quarter was an improvement in the global stock market, which brought much of these markets back to break even. Within U.S. stocks, large cap stocks posted small returns, while small cap trailed by a growing margin. As reported last quarter, Pinnacle portfolios have no exposure to small cap stocks, despite improving valuations. At some point, small cap stocks will emerge as an opportunity, but the team continues to avoid them for now. Within foreign stocks, developed country stocks were down slightly, while emerging market stocks were down sharply. Let's dig a little deeper into the results of foreign markets. Looking back over the last several years, we see foreign markets consistently trailing the U.S. Understanding the reasons why and the investment response, especially in more recent periods, is very helpful. Foreign developed stocks were down 0.8% last year, while U.S. stocks, at least large cap, were up slightly. If it were not for the strengthening dollar, foreign stocks would have been up about 5%. Emerging stocks were hit with both the effects of a strengthening dollar and a collapse in commodities, upon which emerging economies are more dependent. So, foreign developed markets performed decently in local currency terms, and part of our exposure to these markets has been hedged to the dollar, removing some of the dollar's eroding effect. Again, we have no exposure to emerging markets, but one has to think that once the commodity crush is over and the dollar ceases to strengthen, another opportunity to own an undervalued asset class will appear. Except for high-yield bonds, which have suffered mainly from the weakness of energy companies, the bond market finished slightly positive. I've already joked with several clients and associates that it's been a so-so year when the best performing asset class is municipal bonds. Commodities continued their dramatic slide in the midst of global shifts in both production and demand, though there have been signs going into 2016 that production growth will start to slow. This asset class has been underweighted in our portfolios, both in direct commodity holdings and commodity-sensitive sectors of the stock and bond markets. While we don't expect a sharp rebound this year, we should remember this can be a very volatile asset class. After being down dramatically over the last 18 months, it's easy to think it'll stay this way indefinitely. However, an objective look at the history of energy and commodity prices would suggest a different story. As you can imagine, the investment team has been very busy in the new year, especially as stock markets have weakened. Their assessment is still similar to that of the last several months of 2015, where the weight of the evidence led them to take less risk than normal. However, minor downgrades in a couple of areas is increasing the likelihood of additional risk reduction in the near term. Finally, a few reminders. While investment markets go up more than they go down, they do go both ways. 2015 gave us what amounts to a pause, not a full correction. Next, volatility is a constant. The financial press would have us believe the market was more volatile in 2015 than normal. That is simply not true. In one of my favorite slides, you can see the U.S. market's low point and closing return for the year. 2015 was in no way out of the ordinary, and we should not let the press or our emotions tell us otherwise. Finally, given the first two reminders, it's good to remember we have a risk management strategy in place so that falling markets can actually present opportunities. Since portfolios are currently underweight riskier assets, market declines can present future opportunities to buy back in at lower prices. As always, we appreciate your business and your confidence. Please let me know if you have any questions, and I look forward to talking with you soon.